Exchange-traded funds, ETFs, are investment funds that are traded on stock exchanges. ETFs are designed to track the performance of a particular index, such as the S&P 500, a specific industry, or a basket of assets like commodities or bonds. ETFs are considered to be one of the most innovative and flexible investment products that have been developed in recent years. They have gained significant popularity among investors due to their simplicity, low costs, and liquidity. ETFs are similar to mutual funds in that they pool money from multiple investors and invest in a diversified portfolio of assets. However, there are several differences between ETFs and mutual funds that make ETFs more attractive to investors. Firstly, ETFs can be traded throughout the trading day on an exchange, providing investors with greater flexibility in managing their investments. Mutual funds, on the other hand, can only be bought or sold at the end of the trading day at the net asset value (NAV) price. This means that investors who buy or sell mutual fund shares during the day will not know the exact price at which they are buying or selling until the end of the day. Secondly, ETFs have lower expense ratios than mutual funds, making them a more cost-effective option for investors. Expense ratios are the annual fees charged by fund managers to cover the costs of managing the fund. ETFs have lower expense ratios than mutual funds because they are passively managed. This means that they simply track the performance of an index or a basket of assets, rather than actively selecting individual stocks or bonds to invest in. Thirdly, ETFs are more tax efficient than mutual funds. Mutual funds are required to distribute capital gains to their shareholders at the end of each year, which can result in taxable gains for investors, even if they did not sell any shares during the year. ETFs, on the other hand, are structured in a way that allows them to avoid these capital gains distributions, making them a more tax-efficient investment option. There are several types of ETFs that investors can choose from, depending on their investment goals and risk tolerance. Some of the most common types of ETFs include broad-based ETFs. These ETFs track the performance of broad market indexes, such as the S&P 500 or the Dow Jones Industrial Average. They provide investors with exposure to a diversified portfolio of stocks and are typically less volatile than individual stocks. Sector-specific ETFs. These ETFs invest in companies within a specific industry, such as technology, healthcare, or energy. They allow investors to focus on a specific sector of the economy and can be used to implement a more targeted investment strategy. Bond ETFs. These ETFs invest in a diversified portfolio of bonds, such as government bonds or corporate bonds. They provide investors with exposure to the fixed income market and can be used to generate income or to diversify a portfolio. Commodity ETFs. These ETFs invest in physical commodities, such as gold, silver, or oil. They provide investors with exposure to the commodities market and can be used to hedge against inflation or to diversify a portfolio. ETFs can be bought and sold through a brokerage account, just like individual stocks. Investors can also use ETFs to implement a variety of investment strategies, including passive investing, tactical asset allocation, and hedging against market volatility. Passive investing is a strategy that involves investing in a diversified portfolio of assets that track a particular index or market segment. This strategy is based on the belief that over the long term, the market will provide a reasonable return, and that it is difficult to consistently outperform the market by selecting individual stocks or actively managing a portfolio. Tactical asset allocation is a strategy that involves making strategic shifts in a portfolio based on market conditions or other. If you like this content, please subscribe and like it to encourage and click the bell button to get notifications right away. Thank you, and we'll be back with good content to educate you.